Welcome back. This is time for On the Radar, where we ask an investing professional what they're looking at in today's markets. We're back once again with Nadia Lovell. She's senior U.S. equity strategist at UBS Global Wealth Management in New York. Nadia, you like healthcare stocks at this juncture. You think that investors should remain defensive, and this is one way they can do that.
Yes, absolutely. We do. I mean, healthcare, when you look at healthcare, how healthcare typically does, in and out of recession, that earning stability, the innovation continues to happen in the space. Now, of course, there's some concern around drug pricing reform, which I know we will talk a little bit more about. But we think that some of the things that you're coming out of Washington will be manageable for the space.
Okay, you provided us with a graph which shows the relative valuation of the U.S. healthcare sector versus the S&P 500 over a stretch of years. That graph is up on our screen now. Tell us what viewers are looking at.
I mean, what you're looking at here is the relative valuation, the forward PE multiple of healthcare versus the S&P 500. If you look at that chart, pre-2015, you saw that healthcare traded at a valuation premium to the market. And since then, it has really struggled and been trading at a discount. And some of that has been due to this drug price and reform debate that has been an overhang on the space since 2015 during the presidential election campaign, when candidates really tweeted and vowed to bring down drug pricing. So we think that now the Inflation Protection Act that's making its way through Congress and likely to be passed and become law next week is a lot more manageable for the space than any prior proposals that we have seen. What it does is that it will, allow for Medicare, the federal healthcare insurance program, primarily for senior citizens, to negotiate with pharmaceutical companies the price that they pay for certain drugs. It also will expand, the subsidies for the Affordable Care Act, as well as have an annual $2,000 cap on Medicare beneficiaries' out-of-pocket costs for prescription drugs. So we think net that this will alleviate some of the pressure on the industry and cause a sentiment relief and could allow for valuation multiple expansion. We also think that it lessens the risk for any sort of additional significant reform for the next decade, as we think that the government is more likely to focus on implementation of this act and wait and see approach to see the impact on the healthcare system and the industry.
A lot of us remember a tweet from Hillary Clinton in the campaign leading up to the 2016 presidential election. How influential? It was a tweet in which she pledged to bring, in very simple terms, to bring drug prices down. How influential was that tweet in terms of healthcare stock valuations?
It was. You saw that it crushed valuation. You saw that premium come out of the market because of the uncertainty that it created. Some of the proposals that we have seen over the years have been quite draconian and grim, and would have had a significant impact on the industry's innovation and earnings growth momentum. Potentially put the industry in negative earnings growth. But this new proposal that is likely to become law, we think is a lot more manageable, and so we think that will allow for a reinflation of the valuation multiple for healthcare and that premium multiple that it used to have for that consistent earnings growth and innovation that happens in the space.
The U.S. healthcare sector is a big sector. Which do you favor some subsectors of it over others? You seem to be talking mainly about the drug makers, the pharmaceuticals.
Within healthcare, we prefer the medical equipment and supplies and life science tools and services company, and markets still remain very strong in that area and growth is durable. But the pharma and the biotech are getting a lot more interested, just given the defensive nature of those segments of the market. And now this drug pricing bill potentially could serve as a clearing event. And so we think that there will be select opportunities in that area as well.
And what about the pharmaceuticals?
Absolutely. Pharmaceuticals, we do think that the innovation really continues in that space. Some of the things that we're watching and we heard throughout the earnings season really has to do with, the treatment of small molecules under this bill and whether they will be eligible for price setting in the year 9 after the drug is approved. And that could potentially impact innovation and drug availability in the late stage patients. But we do continue to believe that the pharmaceutical companies will work with Washington to get more clarification about around that. It does have implication for, some potential investment in oral oncology drugs, but orphan drugs are quite protected, so there might be more emphasis there. So we still think that there is innovation opportunities within the pharmaceutical areas of healthcare, and we think as time passes, we'll get more clarity about the implications of, this act. We also think in terms of earnings growth headwinds, we see it as less than a 3% headwind to global biopharma earnings going forward. And remember, a lot of this stuff does not go into play until 2026, where we start to see the government negotiate drug pricing.
Many of these companies, of course, are multinationals that sell their drugs or their medical technology all over the world. But I hear you really emphasizing the U.S. marketplace in terms of changing sentiment and perhaps leading to multiple expansion.
Yes. We are emphasizing the U.S. because, reality is drug prices are higher in the U.S. than they are overseas. So in terms of the profits that are seen, you're seeing most of that profit come from the U.S. Although healthcare does have that global footprint, a good proportion of pharma dependent on the company, 35 and sometimes 50% plus of revenues are coming from overseas. So there are opportunities overseas in terms of growing the top line. But in terms of the earnings growth, it's really going to be driven by the U.S. side, just given the differentials in terms of the difference in prices between the U.S. and outside of the U.S.
And moving to another sector, sticking with your defensive theme, you also like global energy stocks.
Yes, we do. Energy has seen a pullback in recent weeks, just given concerns around recession. But we still remain very bullish on the outlook for oil prices. As we think about where oil prices could be by the end of the year, we still maintain our price target for $125 on Brent. We also had an incredible earnings seasons in the energy companies, blockbuster, many of them seeing record earnings as well as free cash flow generation and returning that cash to shareholders. And so we would take advantage of this opportunity of the pullback in energy stocks to really add there, because there is still that earnings momentum, unlike the rest of the S&P, where we think earnings are at risk. And we think that when you look out for Brent oil price, we think that, of course, what's been keeping down oil prices is also releases from the Strategic Petroleum Reserve, which will end in the fall. And then also we have sanctions that will go into place against Russian oil in December, additional sanctions that we think will put upward pressure on oil prices.